There's a file sitting in a government building in Ottawa with your name on it. You have never seen it. You will never be told it exists, but every April, a scoring system reads your tax return, compares it against what the CRA already knows about you, and assigns you a number. If that number crosses a threshold, a human opens the file. And from that point forward, every line you claimed gets examined under a microscope. I know this because I spent 26 years inside the CRA's Compliance and Audit Division. I watched those files get opened. I sat across from the people who thought their returns were fine. Most of them had no idea what triggered it. And the ones who were retired, the ones who assumed the CRA would leave them alone once they stopped working, they were some of the easiest cases we had, because they never saw it coming. By the end of this video, you will know exactly which 7 patterns the CRA's systems are flagging on retired Canadians right now. You will understand why retirement actually increases your exposure, and you will know what to fix before your file gets pulled. Everything here comes from the inside. I'm not reading the CRA's public guidelines back to you. I am telling you what I watched happen behind those doors for over 2 decades. The CRA audited roughly 62,000 files in a single recent year and found $14.3 billion in unpaid taxes. 2 years later, that number jumped to $18.1 billion, a 25% increase. The federal government has poured another $73 million into enforcement, on top of what was already the most well-staffed tax agency per capita in the developed world. Canada has 1 tax employee for every 800 residents. The United States has 1 for every 4,500. You are watched 5 to 6 times more closely than an American taxpayer. And the tools have changed. The CRA now runs over 200 artificial intelligence projects. These systems pull data from banks, from land registries, from Airbnb, from crypto exchanges, and from over 90 foreign governments. They compare everything against your return before a human ever touches it. But here is the part most retirees miss. When you were working, your income came from a T4, clean, simple. 1 employer, 1 slip, 1 number the CRA already had. The moment you retire, your income fractures. CPP from Service Canada, OAS from a separate department, RRSP withdrawals from your bank, pension income from a former employer, dividends from a brokerage, rental income from a property, maybe capital gains from a sale you made in March and forgot about by December. 7 different sources, 7 different slips, 7 chances for something to not line up, and every mismatch raises your score. The system doesn't care that you're 67 and have been filing clean returns for 40 years. The algorithm treats every return the same way. Your history buys you nothing. What matters is whether today's numbers match what the CRA already has in their database. And in retirement, the number of data points they're cross-referencing against you goes up, not down. Red flag 1. Your numbers don't match what the CRA already has. The CRA receives your T4A, T5, and T3 data before you even file. When your return arrives, the system lines everything up automatically. If a slip says you received $8,200 in RIF income and you reported $7,400, the discrepancy gets flagged without a human looking at it. There is no judgment call involved. The machine catches it. This trips up retirees constantly. A T3 from a mutual fund distribution you forgot about. A T5 from a savings account you barely use. A slip from a pension adjustment you didn't realize was reported separately. Each one is small. Each one is enough. I've seen files get opened over $200 discrepancies. The amount didn't matter. What mattered was the mismatch. Because from the CRA's perspective, if you got one thing wrong, you might have gotten other things wrong too. One flag leads to a deeper look. A deeper look finds more questions. And suddenly a $200 slip turns into a full review of your entire return. And since January 2024, digital platforms, Airbnb, VRBO, Etsy, Uber, report your income directly to the CRA. If you rent out a cottage for 3 weeks every summer and pocket the cash, they already have the number. The question is whether your return matches it. Red flag 2. You sold property and didn't report it. Real estate audits jumped 17% in a single year. Between 2015 and 2023, the CRA reassessed $2.7 billion from approximately 75,000 real estate audits. This is their highest return program. They will keep funding it because every dollar they spend here brings back multiples. Here is what catches retirees. You sell the family home. The gain is exempt under the principal residence exemption. You assume that means you don't have to report it. Wrong. Since 2016, you must report the sale on Schedule 3, even if the gain is completely tax-free. If you skip it, the CRA can deny the exemption entirely until you file properly. And if they decide you were negligent, the penalty hits 50% of the understated tax on top of what you owe. I watch people lose exemptions worth hundreds of thousands of dollars over a form they didn't know existed. The house was genuinely their home. The exemption was legitimate. But they never filed Schedule 3, and by the time we contacted them, the clock had already started running on penalties. There is another layer to this. If you sold a residential property within 365 days of buying it, the profit isn't treated as a capital gain at all. Under the anti-flipping rules that took effect in January 2023, that profit is classified as 100% taxable business income. There are exceptions: death, divorce, disability, job relocation, but the default is harsh. And even if you held the property longer than a year, the CRA can still argue it was business income if the facts suggest you bought with the intention to resell for profit. For retirees who downsize, this usually isn't the issue. The issue is the reporting gap. You sell the family home, assume the exemption covers everything, and skip the paperwork. That filing gap creates a second problem, because the CRA now has to decide whether you forgot or whether you were hiding something. Red flag 3. Your TFSA looks like a business. Most Canadians think TFSAs are untouchable. They are not. If you are buying and selling frequently inside your TFSA, day trading, using leverage, trading options, profiting from short-term price swings, the CRA can reclassify every dollar of gains as fully taxable business income. There is a real case. A licensed investment advisor contributed the maximum to his TFSA, traded aggressively in penny stocks, and grew it to over $617,000. The tax court ruled he was carrying on a business. All of it was taxable. And the court specifically noted that Parliament chose not to give TFSAs the same protection that RRSPs have against business income from trading. The frustrating part is, there are no exact rules. No specific number of trades that triggers it. No bright line. The CRA looks at the pattern, frequency, volume, holding period, your level of knowledge, and makes a call. That ambiguity is the weapon. It means any aggressive trading inside a TFSA is a gamble with the CRA, and the CRA gets to decide the odds after the fact. There's a second TFSA trap that catches retirees who never trade at all. Over-contributions. The annual limit this year is $7,000. The cumulative room depends on when you became eligible. The most common mistake is simple. You withdraw money in March and you put it back in June. That room doesn't return until January 1st of the following year. If you were already maxed out, that recontribution counts as an over-contribution. The penalty is 1% per month on the excess amount. It's quiet. It adds up. And by the time most people notice, the bill has been compounding for months. Red flag 4. You hold foreign property worth more than $100,000 and didn't file the T-1135. This one catches retirees who do everything else right. Foreign property doesn't just mean a condo in Florida. It includes shares of U.S. corporations held in a Canadian brokerage account. It includes funds sitting in a foreign bank. The threshold is based on cost, what you originally paid, and it applies at any point during the year. If your holdings crossed $100,000 in June but dropped below by December, you still had to file. The penalty for missing it is $25 per day, up to $2,500 per year. Gross negligence pushes that to $12,000 per year. And here's the part that makes it worse. A missed T1135 extends your reassessment period by 3 years. Your entire return stays open for 6 years instead of 3. That means the CRA can go back and pull apart everything, not just the foreign holdings. A recent tax court case made the stakes clear. The court ruled that you cannot escape penalties by saying you relied on your accountant. The judge's words, "Reasonable diligence demands more than passive reliance. You are responsible for knowing whether this form was filed." Red flag 5. Your deductions don't match your peers. The CRA knows what normal looks like for your income bracket, your region, your profession. They have averages. If your home office deduction, vehicle expenses, or charitable donations sit far outside those averages, you stand out. A reviewer opens the file and starts asking for receipts. After COVID, home office deductions exploded. The simplified $2 per day method expired after 2022. If you are still claiming a home office, you need the detailed method now, and the numbers need to hold up. Claiming 50% of your home is office space on a retirement income is exactly the kind of mismatch that pulls a file out of the pile. And your charitable donations carry the same risk. The CRA reviews every credit before paying it. Large donations relative to income, particularly to organizations already under scrutiny, will get a second look. Red flag 6. The CRA already knows about your offshore accounts. Through something called the Common Reporting Standard, the CRA now exchanges financial account information automatically with over 90 countries. Over 120 jurisdictions participate globally. If you have money sitting in a bank account in Portugal, in Mexico, in the Philippines, the CRA likely already has the balance. This is the part I want you to sit with. When I started at the CRA 26 years ago, offshore money was nearly invisible. We had to request information through diplomatic channels. It took months, sometimes years. A taxpayer with money in Switzerland or the Caribbean could go an entire career without being detected. The process was slow enough that many people assumed they would never be caught. That world ended around 2014, and most Canadians still haven't caught up to how much the CRA can see now. I remember the shift happening in real time inside the department. One year, we were sending formal requests through embassies and waiting 6 months for a reply. The next year, foreign account data started arriving automatically, in bulk, with names, balances, and account numbers attached. The volume of information was staggering. It took years to build the systems to process all of it, and those systems are getting faster every quarter. Every year, the net gets tighter. Every year, more countries join the exchange. The question stopped being whether the CRA would find out. It became whether what you filed matches what they've already been told. Red flag 7. Someone reported you. The CRA runs a leads program. Anyone, a neighbor, an ex-spouse, a former business partner, a disgruntled family member, can file a report. You will never be told who did it. You will never be told it happened. But a human will look at your file, and if anything on your return looks off, even slightly, the audit process begins. You cannot control whether someone picks up the phone. You can control whether your records hold up when the file gets opened. And this connects to something most Canadians don't realize. When the CRA questions a line on your return, the burden of proof is on you. Most people assume it works like a courtroom, innocent until proven guilty. With the CRA, the assumption goes the other way. They make an assessment. You have to prove them wrong. If you can't produce the documentation, the claim gets denied. Period. I watched that dynamic play out hundreds of times. The taxpayer says the expense was real. The auditor asks for the receipt. There is no receipt. The deduction disappears. It didn't matter whether the expense actually happened. Without paper, it didn't exist. Every single one of these red flags comes back to the same thing. The CRA has your data before you file. Their systems compare it against your return automatically. When something doesn't line up, a human opens your file. And once that happens, the burden is on you to prove every line. The retirees who get through audits cleanly all have one thing in common: a folder. Receipts, slips, property records, contribution logs, foreign account statements, all organized, all current. It sounds boring, because it is boring. But boring is what keeps a file closed. I'll tell you something I noticed over 26 years of watching audits unfold. The people who fought the hardest were almost never the ones committing fraud. They were ordinary Canadians who genuinely believed they'd done everything right and got blindsided by a rule they'd never heard of. A form they didn't file, a slip they didn't check, a withdrawal they made in the wrong month. The frustration on their faces was real. And most of the time, the fix would have taken 10 minutes if they'd known about it before the letter arrived. If you have already made mistakes, missed a T1135, forgot to report a property sale, over-contributed to your TFSA, the CRA overhauled its voluntary disclosure program in October 2025. If you come forward before they come to you, you can get 75% interest relief and full penalty relief. Even if the CRA has already contacted you about an issue, the new prompted disclosure category still offers 25% interest relief. 2 years ago, that contact would have disqualified you entirely. Coming forward costs money. Getting caught costs significantly more. Interest compounds. Penalties stack. Professional fees multiply. And the reassessment window stays open longer than anyone wants. I spent 26 years watching people sit across the table from CRA auditors. The ones who kept records walked out. The ones who didn't paid. Every one of these 7 red flags is fixable if you know about it before the CRA opens your file. Now you know. If you want to see the tax mistakes that quietly cost Canadian retirees thousands every year, watch the video on your screen right now. And subscribe, because every week this channel covers what the CRA will never tell you.